Right now, the major market indices look perfectly stable, but underneath the surface, specific household name companies are taking sudden, violent dives. These sell-offs aren't triggered by bad earnings reports or corporate scandals. The underlying businesses themselves haven't actually changed. When you look at the sheer volume of trades happening on the floor of the exchange, it's easy to see why retail investors get spooked. You see a blue-chip stock tank and assume someone knows something you don't. CNBC's Jim Cramer argues this exact chaos has pushed 5 high-quality companies into deep discount territory. The problem is figuring out if you're looking at a genuine bargain or a value trap waiting to catch eager buyers. A lower share price alone tells you nothing. To capitalize on a drop, you must figure out if the company's core engine is broken or if Wall Street is just changing the weather. Think about how a $100 billion institutional fund actually operates. When they decide to move capital, they aren't day trading individual stocks. They move based on macroeconomic signals. When a single data point like a slowing U.S. jobs report hits the wire, institutional managers instantly revise their entire economic outlook. This animation shows the actual mechanism of a market rotation. Mega funds don't surgically trim individual underperformers. They dump entire sectors wholesale to reallocate cash into areas they think will survive the new economic environment. Notice this isolated node left behind. That represents collateral damage. A perfectly healthy company gets caught up in the indiscriminate selling, punished simply because of the sector box it sits in. Because institutions move billions overnight, this chain reaction of selling happens faster than the market can price in the actual value of the companies. Wall Street's mechanical need to shift massive amounts of capital creates a temporary window where excellent businesses go on sale, strictly because they were in the wrong sector at the wrong time. Financial media often presents a list of 5 completely different stocks as a single monolithic batch of buys. A discounted stock only works for you if its underlying structure aligns with your specific portfolio strategy and risk tolerance. We can map these opportunities using this 2x2 matrix to stress test Cramer's list. The horizontal axis measures risk, from defensive stability to aggressive turnaround. The vertical axis tracks the macroeconomic environment, from relying on consumer strength to actually thriving in consumer weakness. Up here in the top left quadrant, we have our defensive anchors, PepsiCo and Johnson & Johnson. Buying into staple food, beverage, and focused pharmaceuticals adds ballast to your portfolio. When high-growth tech stocks face heavy selling pressure, these specific sectors tend to hold their ground. They generate reliable dividend yields because consumers will continue buying baseline groceries and medications, regardless of whether the broader economy is panicking. The trade-off is strict. If the economy rapidly accelerates and capital floods into aggressive growth assets, these stable companies will severely lag behind the market. Buying the dip on a defensive anchor provides capital preservation and passive income. It is not a vehicle for rapid wealth generation. Now consider a different scenario. If you look at a slowing jobs report and expect a prolonged, severe economic downturn, you need a different tool entirely. Returning to our matrix, we plot TJX Companies down in the bottom left quadrant as a true counter-cyclical asset. TJX operates by purchasing excess, unsold inventory from struggling premium retailers at massive discounts, then passing those savings on to their shoppers. This creates a rare dynamic where the business mathematically strengthens as the economy weakens. Financially squeezed consumers stop paying full retail and actively trade down to the discount racks. The risk you take on here is deliberate underperformance during an economic boom. When rising wages send shoppers back to full-price premium stores, TJX loses its specific advantage. Allocating capital to TJX during a market rotation is a targeted, structural bet against the broader financial strength of the American consumer. Finally, we have to address the dangerous side of a market sell-off. Some stock drops are completely justified by the math and carry intense risk. Here, on the far right side of the matrix, we plot SBUX and Constellation Brands. These are aggressive, high-risk turnaround plays. Unlike the collateral damage we saw with our defensive anchors, these companies are bleeding because of actual internal problems. They are fighting shifting consumer behaviors and steadily slowing product sales. You only buy into these assets because they offer the highest possible percentage returns. If and only if the new executive management teams successfully execute radical internal overhauls. If those CEOs fail to fix the core rot, you are catching a falling knife, and the stock price will likely continue to collapse. These specific stocks are not victims of an indiscriminate market rotation. Buying them requires blind faith in corporate leadership, making them highly speculative gambles compared to a stable blue chip. Ask, is the drop sector-wide or isolated? Isolated means internal flaws. If sector-wide, has the business degraded? Yes is a value trap. No is a rotation opportunity. Match this bargain to your strategy. Conservative target, recession hedge, or aggressive upside. Use PepsiCo and Johnson & Johnson to preserve your capital. Use TJX Companies to hedge against consumer weakness. And touch SBUX or Constellation Brands only if you can stomach aggressive turnaround risk. It's easy to get caught up listening to TV analysts list off their favorite ticker symbols, but you have to look past the hype and rely on structural portfolio mechanics. A true market rotation is not just a green light to blindly buy a basket of discounted stocks. It is a stress test of your discipline, demanding that every dollar you deploy serves a deliberate, calculated function in your portfolio.